Journal entries for P2P cycle. Please see this video after getting acquainted with payables and P2P courses. This video summarizes all the journals that are made in different steps of P2P cycle. If you want to execute the steps, you would need GL roles. GL roles you will need only if you want to see any journals. Otherwise, just the FSM and other roles should be sufficient. If you intend to see any journals, also provide the data access for US primary ledger. And environment is Fusion Applications Release 13. Concept and example. There are basically three types of journals: the budget journals, encumbrance journals, and the actual journals. And that is identified by the balance type on the journal. B stands for budget. So when we create the budget amounts are uploaded and they can create budget journals. That is mainly used for expense analysis, for budget and actual comparison, or it could be for expense control, for allowing or disallowing the transactions beyond the budget amounts. And budget journals can be created for any GL accounts. Mostly they are applicable to expense accounts for the sake of control, and they need not be balanced for debit and credit totals. You can just have, say, 4 or 5 account combinations, expense account combinations, and give some debit amounts, and there need not be a credit line at all. Budget journals do not affect the trial balance, profit and loss, and balance sheet. The purpose of the encumbrance journal is to set aside some amounts from the budget without making an actual expense. So there can be situations where we have not made an actual expense, but we have committed for the expense. So it is like a pre-allocated expense amount, but the expenditure has not actually happened yet. For example, approval of requisition. This is a stage where we commit some expense, but at this stage we are not incurring the expense. Similar to budget journals, even the encumbrance journals do not affect the trial balance, profit and loss account, and balance sheet. The actual journals are the regular journals we always talk about, like the AP invoice journal, the payment journals, the AR invoice journals, and so on. And they basically happen when the actual expense happens. This does not mean when the actual expense is paid. Actual expense happens based on the accrual principle that should be sufficient to record an actual expense. So if there is any related encumbrance, that needs to be reversed to avoid the duplication in such a case. And the trial balance, the profit and loss account, balance sheet, all those final accounts that we publish, they are all the result of actual journals without considering the budget and encumbrance journals. Some of the examples are like setting a budget of USD 25,000 per month. This will create budget journals. Encumbrance journal would be a PO approved for traveling expense, USD 4,000. And an actual journal will come when we receive an invoice from a vendor. Let us say an airfare ticket is received with the invoice for USD 3,000. So we will create an AP invoice and an actual journal will be created from that. Now let us see what are all the journals created in P2P accounting. We have divided it into 4 cycles. Our first cycle is P2P with no receipt, no material receipt, no service receipt. And for this we are going to refer to accounting flow 1. The item receipt is not required in this flow. So let us go to accounting flow 1 in our spreadsheet. So this is a spreadsheet that narrates all the flows, and basically there are 2 tabs: P2P accounting flow for encumbrance and the accounting flow for actual. So we are right now focusing on this particular flow. So let us mark it like this, and let us mark it also in the actual. So this is our encumbrance flow. Let us start with the requisition. The first point of the transaction is the requisition. The moment a requisition is approved or submitted, depending upon how we have configured it. Suppose we have configured it in a way that when we approve the requisition, it triggers the encumbrance. In that case, the accounting that will happen with balance type is equal to E, as the PO charge account will get debited and the encumbrance reserve account will get credited. We'll see at a later stage from where these accounts come from, how these accounts are defaulted, how these accounts can be edited, whether they can be edited or not on the transaction, and finally how the accounting happens. But right now we are just discussing the journals for it. So in this requisition encumbrance, a commitment type of encumbrance is created. Then comes the PO stage. Let us say, as we have configured, it can again be at the time of approval or at the time of submission. Another encumbrance gets generated for the PO, which is PO charge account is debited and encumbrance reserve account is credited. Now this will result in duplication because we are making an entry at the time of requisition also and a PO also. So the requisition encumbrance is reversed here. In point number 2, this is a reversal of the encumbrance that was created at requisition stage. This is called as liquidation of the encumbrance. And then a new encumbrance for PO is created, which is an obligation type. The charge account and PO charge account can basically be any expense account like travel expense, security expense, administrative expenses, and so on, depending upon the service that we have procured. And at times it can be accrual, expense accrual, inventory accrual, and so on, inventory valuation at the stage of receipt and so on. So all those accounts we will see. But right now that is most probably the expense account, and this is kind of an ownership account, encumbrance reserve. After the completion of PO, there is no receipt stage because this accounting flow 1 relates to P2P without a receipt. So there is no receipt, no accounting, no delivery, no accounting here. Directly after this, an AP invoice will be created. When an AP invoice is matched and accounted, matched with PO and the invoice is accounted, this PO encumbrance is liquidated. Because at this stage, now it is no longer an encumbrance. At this stage, this has become an actual expense. So this is a reversal of 3. The PO encumbrance is reversed. Below that, this is periodic accrual. This flow has nothing to do with periodic accrual. We'll see when it comes to that. Now this is just about the encumbrance. Let us see the actual entries in the same flow. So let us go to actual. For requisition and PO, there is no accounting journal created for balance type is equal to A. At both of these stages, there is no receipt, there is no delivery. So at the time of AP, the first actual entry is created when the AP invoice is matched and accounted. When the PO charge account gets debited, it is the same account which is used on the PO distributions, and AP liability account is credited. The sources, how these accounts default, that is all explained in the payables journals video, which is a GL12 video. You can refer to that video if you want to see the additional information about this one. Then comes the payment. Issue of the payment creates AP liability account debit, cash clearing account credit. The AP liability comes from the supplier site assignments. This AP liability account comes from supplier site assignment, and this AP liability comes as a business flow from this entry. The cash clearing account comes from the bank account, the business unit access tab, and then at the time of clearing and reconciliation, the cash clearing account is debited and cash account is credited. This is the actual clearing. This cash clearing and cash account again also comes from the bank account definition, the business unit access tab. So that is all about the first flow, which is quite simple. Now let us go back to our guide and navigate to the next flow. So this is P2P with an inventory item. POs requiring inventory item receipt. And we are going to refer to the accounting flow 2 for this. An inventory item receipt is required because on the PO lines we have taken an item, inventory item. For inventory items, the accrual is always at receipt. There is an option accrual at receipt or at the period end which applies only to the expense items. If you take an inventory item, the accrual is always at receipt. For pay on receipt, the same flow of accounting will apply, although the flow of business process is different. But the accounting flow is the same. Let us navigate to our Excel again. So in this accounting flow 2, for the requisition and PO, the complete encumbrance flow is exactly the same up to the PO creation stage. But it differs from accounting flow 1 as far as the liquidation of the PO encumbrance is concerned. So the PO encumbrance gets liquidated at the time of receiving of the item. In the receiving of the item, there are two stages. When we receive an item, first of all, it is received in a bay, and later on, it is put away to the delivery location of the item. And the accounting of the receipt is split into two parts, like the first part is receiving and the second part is delivery. In the first part of receiving, the encumbrance of the PO is reversed. And at this stage, there is no encumbrance in the system, as the only encumbrance here we had was from the PO. In accounting flow 1, the encumbrance got reversed at the stage of AP invoice matching and accounting. Whereas in accounting flow 2, this is getting reversed at the time of receiving of the item. Let us move on to the actual. Below this, there is nothing. The actual accounting for receiving is receiving inspection account debit, which is kind of a clearing account, and inventory accrual account is credited here. At the time of delivery, the inventory valuation account will get debited. So the inventory valuation is increased here. The receiving inspection account, which was debited here in number 1, the same account gets credited here. Rather, the same account should get credited here because here it does not follow the principle of business flow, but it follows another principle of acquiring the accounts through transaction account definitions. Then the purchase price variance account is debited or credited. This is basically a difference between the item cost and the purchase price. After that, when the AP invoice is matched with the PO and accounted, the inventory AP accrual account is debited. It is the same account that we credited here. It is written as inventory accrual here and it's inventory AP accrual, but it's the same account. And invoice price variance, which is a difference between the invoice price and the purchase price, that is debited or credited here, and AP liability is credited. I repeat once again here, the invoice price variance is the difference between invoice price and the PO price, whereas the purchase price variance is the difference between PO price and item cost. Now for payment, the accounting is the same. Again, AP liability account is debited, cash clearing credited, the same as this one. And at the time of clearing, cash clearing is debited, cash account is credited. So that completes our flow number 2, and let us navigate back to our guide. So the next one, now P2P expense item, POs requiring expense item receipt, and when we have configured accrual at receipt. Whenever there is an expense item or expense destination, we can configure whether the accrual should be done at the time of receipt or at the time of period end. So this particular case is accrual at receipt. And we are going to refer to accounting flow 3 for this. Let us move on to our spreadsheet. The encumbrance accounting for requisition and PO remains the same here. At the time of PO receipt, the receiving part, the encumbrance is reversed for the PO, which is again same as the accounting flow 2. So at this stage, there is no encumbrance left for this transaction in the system. So below this, it is all blank. Let us move on to actual. Requisition and PO, they never have the actual accounting. So actual accounting takes place when we do the PO expense item receipt. At the receiving stage, receiving inspection is debited, expense accrual is credited here. Then at the time of delivery put away, the PO charge account is debited, which can be an expense account depending upon which service or which expense item we have procured. And receiving inspection account, the first two account, the same account is credited here. Then comes the stage of AP invoice being matched and accounted, matched to the PO. The expense accrual account is debited, which is the same account as this, and AP liability is credited. Payment is the same, AP liability debit, cash clearing credit, and the cash clearing debit, cash account credited. So that completes our flow number 3, and move to our guide. So this flow relates to the expense item where the accrual is at the period end. POs requiring expense item receipt accrued at period end. Let us move to our spreadsheet. For the encumbrance, once again, the requisition and PO, they have the same entries for encumbrance. For PO receipt, rather than saying no receipt, this is actually there is no receipt accounting. Although there is a receipt done and there is no delivery accounting done here. Because we are going to accrue it at the time of period end. So we are going to do periodic accrual for this. And the entries are going to happen at the time of periodic accrual. So the receipt happens, the delivery happens, but the receipt accounting and the delivery accounting does not happen at this stage. At the end of the period, there is some accounting which is going to happen. But before that, let us talk about the invoice. Now, one important thing to note here is the invoice matching and accounting may happen before the period end comes, or the period end can come first. Suppose your invoice comes in 3rd February for something you procured in January. So at the end of January, the periodic approval will happen first. That is another case. Or if you have received an AP invoice, let us say on 25th of January for the January procurement, then your accounting for the invoice will happen before the period expires. So there are two cases here. So whichever event happens first, it could be either AP invoice matching and accounting, or it could be periodic accrual. Whichever event happens first is going to reverse the PO encumbrance. In case the periodic accrual happens first, in the January-February example, your invoice is coming in February. So end of January, these two entries will happen. encumbrance reserve will get debited and PO charge will get credited. It's a reversal of the PO encumbrance. Liquidation of the PO encumbrance. And in the next month, the accrual itself gets reversed. Therefore, the encumbrance that was reversed again needs to be reinstated or reinforced. So this liquidation of the encumbrance reserve gets reinstated with this entry, which is the same entry as creating an encumbrance again at the beginning of the next month. So later in the next month, the AP invoice matching and accounting happens. That time, this reinstated encumbrance will get reversed here. So this could be a reversal of 3 or it could be a reversal of 6, depending upon which of these two events have occurred first. Now let us take another case. If you get the AP invoice first before the end of the period, then it will directly reverse the encumbrance of the PO at this stage itself. And at the end of the period, there will be no entries happening here. As if you carefully see here, this is an accrual of uninvoiced receipts. And we are saying that the invoice has already happened in the month itself. So it is a receipt which is no longer uninvoiced. It is an invoice receipt. So this accounting will not happen for that. So the accounting cycle will end here at 4 for transactions where AP invoice happens before the end of the period. So this is all about the encumbrance. Now let us go to the actual flow. In the actual, again, as always said, requisition and PO never have actual accounting. No receipt accounting. There is a receipt, but there is no accounting for the receipt. And no delivery accounting. For the AP invoice, that is the accounting that will happen, PO charge account debit and AP liability account credit. At the time of accrual, these two entries will happen. Now here again we have the same situation. If the AP invoice happens first, then PO charge is debited, AP liability is credited. 2 and 3, this accounting will not happen at all. Because at this stage, as invoice has already happened, this is not an uninvoiced receipt. This is an invoiced receipt. There is no question of doing this accounting. And since we are not doing this accounting, there is no question of doing the reversal of that accounting also. The reversal of accrual, now we will see case number 2. When the period end happens before we receive the AP invoice. The same example, we procured something, PO was released, let us say on 5th of January. We received invoice on 10th of February. And 31st of January, that is the end of the month. Until that, we have yet received the item, but we have not invoiced it. So this is an uninvoiced receipt. So these two entries will happen. This will happen at the end of the January, PO charge account debit and expense account credit. And in the beginning of February, that will get reversed. Expense accrual account debit, the reversal of this 2 number. And PO charge is credited. When on in February the AP invoice is accounted and matched, the PO charge account will be debited and AP liability account will be credited. There is no duplication because these entries are already cancelled due to the reversal. Next, the payment, as usual, the issue is AP liability debit, cash clearing credit, clearing and reconciliation, cash clearing is debited, cash account is credited. So we have completed this flow number 4 also. Coming back to our guide. So any accounting process generally has 3 stages. The first stage is defaulting. Here a pre-configured account defaults on a transaction. For example, PO charge account defaults from transaction account definition to PO distributions. An easy example could be an AP expense account defaults from the distribution set attached to the supplier side. From there, it defaults to the invoice. The next stage is editing. You can edit the account combination at transaction level after it is defaulted. This is allowed for a few accounts, like PO charge account can be edited if it is an expense flow, but accounts like accrual, etc., inventory valuation, they cannot be edited on your PO distributions. The third stage is accounting, when the actual accounting happens when the create accounting program is triggered. In the context of P2P, the defaulting happens through the transaction account definitions. The editing is allowed only for PO charge account for expense item or destination on PO distributions. Other accounts like inventory valuation, accrual, PPV and all, we cannot modify them manually on PO distribution. And then the final accounting can happen through the subledger accounting. The SLA rules will use the edited transaction distribution account, or it will use the transaction account definition, or the mapping sets if TAD results in null combination. We'll see how this works. Budget accounts are uploaded as budget amounts and budget journals are created. There is no question of defaulting and all that. For encumbrance accounts, the accounts are derived as follows. The reserve for encumbrance account is taken from manage budgetary control. Now, one thing to note here is the budget and encumbrance, both of these are optional. Encumbrance can be used only if budget is enabled. So you can have budget without encumbrance. You may not have budget as well as encumbrance. Both you can keep optional. But you cannot have encumbrance without using budget. The credit account is reserved for encumbrance. Let us go to this manage budgetary control task in our instance. Let us open the instance in another tab, or maybe this is open here. Go to setup and maintenance, financials, and manage budgetary control. Open this. And let us choose a budget. Let us say this one. Edit it. And you can see this enable encumbrance accounting is not checked here. If you check it, you will see this reserve for encumbrance account appearing here. So from this, it will take the reserve for encumbrance account. And the PO distribution account will be defaulted in the same way as mentioned for the actual accounts. We'll see the actual accounts, how all of them get defaulted and so on. There is a bit of typo here. It is mentioned, the D is missing. The actual accounts, the P2P accounts for receiving and delivery transactions can be set up using transaction account definition called as TAD or mapping sets. So if we go to the spreadsheet, we will see in the actual tab, all the actual accounting starts from the receiving and delivery. That is the reason we are beginning with this receiving and delivery transactions. Now note carefully, if the TAD results in a null account, then mapping set is evaluated. Hence, if you want to set up mapping sets, you may ensure TAD is not set up. As an example, refer any account rule from the following accounting method. Now let us go to this standard accrual. As we have seen earlier, there are three things. First is defaulting, second is editing, and the third is accounting. The defaulting happens through the transaction account definition, and the accounting can happen through the edited transaction account or transaction account definition or the mapping set. So we are looking at that final accounting part, which is in accounting method of subledger accounting. So this is the accounting method we are going to check as an example. So let us go to the instance and go to setup and maintenance, financials, manage accounting methods, and let us go to say payables. Open it, search for standard accrual with encumbrance, this one, and edit. Note that the currently selected tab is payables. There are other two tabs like receipt accounting and cost management. In Fusion Cloud, the accounting for the first part of the receipt, that is the receipt. Let us go to this Excel. There are two parts, receiving and delivery. The receiving part happens through receipt accounting, and the other one, the delivery part, this one happens through the cost management. So let us go to receipt accounting first. So this is receipt accounting. In receipt accounting, we have to see the event class receiving. The application is receipt accounting. We are already there. Now we have to go to event class receiving. Event class receiving. And within that, receipt into inspection as the event type. So here, receipt inspection, this one. Now if you see, this is a rule set. Let us open this rule set and scroll down. There are many journal line rules. You can see that accrual is accrual. Then receiving inspection is receiving inspection, and so on. Now let us select this one and go to this receiving inspection account combination rule. Open it. Receiving inspection. Now what does this relate to? Let us go back to our spreadsheet. In this spreadsheet, we are talking about this receiving, and the first line we are talking about, the receiving inspection account debit. That is what is done by this particular account rule. Receiving inspection. This is a line rule, so it determines just a line. If you see here, we scroll down further. This is code combination identifier, and this is receiving inspection. You can see the conditions. Go back to code combination identifier. This is some condition finally saying code combination identifier all is not null. So first it will attempt to take the account from the transaction account definition. If this is null, it will attempt to take the account from the mapping set. There are two lines. It would have been sufficient if there was just one line. So this is about the receiving inspection. Now let us click done. Choose another account. Let us choose accrual and open the rule. Now in this rule of accrual also we will see the same thing. Go to the code combination identifier. The last part is code combination identifier is not null. So if it is Not null, it will take it. If it is null, it will go to the mapping set called accrual and the account will be taken from there. Click done. You will see that the same thing repeats for all the accounts. You take another account, let us say expense accrual, open the code combination rule. Once again the same source and the mapping set will be different for each account. But the source code combination identifier and the line mapping set, it is the same feature. The code combination identifier is a dynamic source which can take an edited account or it can take a transaction account definition. Going back to the guide, so we have seen this, how this receiving event class and receipt into inspection have the account combination rules defined, and we can also see the same for another event class which is in cost management application. So let us go to instance, click done. And we'll click done here as well. So it goes back to our standard accrual with encumbrances accounting method. Go to cost management and this part we have to remove now. Now you can see there are different event classes and event types. If you see this PO delivery into inventory, this event class, this should be type here. It's a typo. The PO delivery into inventory will do the accounting for this part, delivery. So go to this one, PO delivery into inventory. And let us query that here. This is the one. Open it. And you can see different accounts needed for the accounting. You can see this purchase price variance getting reflected here in our entry for delivery, purchase price variance. So these relevant accounts will come into this particular rule set. These are also similar to the ones that we saw earlier. So this is how basically the accounts will be taken for doing the actual accounting. For defaulting the accounts, we can see the transaction account definitions. Now, how to define these transaction account definitions, that is a topic in itself. And that has been explained already in P2P videos. You can go and see that. But let us quickly see where we can assign the transaction account definition. Go to the instance, setup and maintenance, and go to procurement here and manage subledger accounting options. For procurement transactions, open it, give a ledger name and search. Now look for purchasing here and click on accounting options. You can see here there is a transaction account definition you can assign. So like you can choose a transaction account definition here and just click save and close and click done. To actually see the definition of TAD, go to this one, open it. This is the one we assigned just now. you can open this one and you can see that different accounts can be assigned here. There are too many columns. So there is accrual account, PO charge account, variance account, and then there is destination charge account, destination variance account for centralized purchasing. So all these accounts, basically you can create an account combination rule and assign here. For all that, you can see the P2P videos as how to do that. This video only focuses on summarization of the journals and an overall logic of how things are defaulted and final accounting is done. Back to our guide. Now let us go to the mapping sets. Earlier, we saw many different mapping sets which play a role in doing the final accounting in case the code combination identifier results in a null value, that is a source used in the account rule. If you want to recap, we can just quickly go back here and open one of these accounts. Let us say purchase price variance, and open this one, and you can see a mapping set referred here with the name of the mapping set as purchase price variance. Now let us go to our guide. All those mapping sets that are mentioned are listed here. So right now we saw this purchase price variance in cost management. If we want to actually check the definition of the mapping set, we can go to the instance, open it in another tab, setup and maintenance, and here we can go to manufacturing and supply chain, manage mapping set for cost accounting, manage mapping sets. We will have to select the scope, and we should choose cost management, and search for purchase price variance or anything else. Select it and edit. Now you can see this purchase price variance account can be defined here after you specify a chart of accounts. For different organizations, you can specify different accounts, and there are multiple input sources provided here. So one important tip here already mentioned, the invoice price variance is the difference between invoice price and PO price, and it comes in Payables Invoice Journal. Refer GL12 for this. Whereas purchase price variance is the difference between PO price and item cost. It comes in the delivery journal, means second part of receiving. Now comes the payables accounts, which we have already seen in GL12 video. So you can see how all these accounts like expense, AP liability, tax, withholding tax, and so on, they default and they get accounted in payables. So refer to this video GL12. I think this is also a typo. GL12 it should be. Thank you for watching the video, and you are welcome to OracleErpGuide.com.